Hello, bond investors. I'm Steve Shaw, founder of Bond Savvy. Today we're going to talk about the 5 reasons long-term bond investors can benefit from the high recent inflation we've been having. Remember, if you like this video, subscribe to the Bond Savvy YouTube channel, give the video a like, comment on the video, and I'll respond as quickly as possible. But in terms of the 5 reasons, what we're going to do is I'm going to run through the 5 reasons, then I'll give some detail on each of them. So the first one is investors have been fleeing from bonds because of high inflation as well as what the Fed's been doing. And it's created enormous opportunities for bond investors. So you've got bonds of some of the world's greatest companies trading at 55 cents in the dollar, 60 cents in the dollar. And some of these bonds are yielding 5.5%, 6%. And given the risk that these bonds have, there are great opportunities that you can take advantage of. And it's been created as a result of what's been going on with inflation. You've got strong company financials. So even as bond prices have fallen, company financials, with some exceptions, have generally been strong. So you're now getting paid more for about the same or even less default risk in many cases. If you look at oil and gas, those companies have paid down significant amounts of debt. They're now in much better financial footing than they were, say, a couple of years ago. And you're seeing really strong yields for those and many other corporate bonds. When we think about inflation, all you hear about on the media and all that kind of stuff is what the headline number is, because oftentimes folks in the media can be a little bit lazy. They just kind of say, all right, 8.3%, that's what inflation is. We don't care who you are, it's the same for everybody. And the thing is that it's really more important what future inflation is, because that's what can impact the value of your bond a lot more than what's going on in the past. We're going to talk about how everyone has his or her own rate of inflation, which can be different than what's published here in the latest CPI report, because this report effectively treats everyone the same, but you've all got different incomes, you've all got different investment portfolios, you've got different lifestyles, you may or may not own your own home. All those different things factor into what your personal rate of inflation is. And last thing is that based on your investment portfolio, so the more you have in your portfolio, the less inflation is going to impact it from the standpoint of your overall purchasing power and what gets spent on those different things. Inflation can have a big impact on bond prices, but in terms of how it could affect the purchasing power of your investments, the more money you have, the less impact it's going to have. All right, so let's first talk about future inflation versus past inflation. So if you think about why inflation could have a negative impact on your portfolio, best is to give you an example. So let's say you've got a bond that pays you 7%, and you bought it at par. So it's paying you 7%. Let's say that inflation for the next 10 years is going to be 6%. Then arguably, depending on what your investment portfolio is, assuming just a normal size investment portfolio, that high rate of inflation could have a material impact on the value of the cash flows that you're receiving from those investments. But what everyone focuses on in the media is, well, what's inflation been for the last year? And yes, it has elevated prices, especially in certain categories such as energy and food and the like. But the fact that this has been high for the last year is, by and large, water under the bridge. Yes, prices are higher, so purchasing power has been somewhat eroded, but what's more important is what happens going out here. And what we've shown here is this is the seasonally adjusted 1-month CPI change. Okay, so if you look at this chart right here, so you see on the y-axis, that's the CPI change each month. You look at June of 2022, it went up 1.3% compared to what it was in May. If you look at, let's say, March of 22, it went up 1.2%. And if you add all these up for the last 12 months, you get pretty close to 8%. Now, this is seasonally adjusted, whereas the headline inflation number that you hear quoted on TV is not seasonally adjusted. But if you think about it, to get to the goal inflation of the Fed is 2%. So you kind of need this to be a little bit south of 0.2%. But when we look at what it was in July, and we look at what it was in August, it was 0.0 and 0.1. So at least we're on a much better path than we had been in 2021. You go back to August of 2021. It was 0.3. So hopefully we're at least in a better path. So the reason why I mention this is that as we think about inflation, we need to think about future inflation. And we're obviously going to keep a close eye on this, but at least the last couple of months have shown some good things. Next, as I alluded to before, is you need to think about inflation, not just what the headline number is, because the headline number, so if you think about what it was this past month, I think it was 8.3%. That number is going to be different for different people. And what I mean by that is, if you think about how the CPI gets calculated, different expense categories are calculated in different, have different weightings. And what the Bureau of Labor Statistics tended to do was say, all right, for a typical consumer, this is about how much you would spend on these different categories. So you see the categories here: shelter, food, energy, medical care services. Those are the top four. Now, we show down here new vehicles and used vehicles. We can combine those because you see the weightings here are 4% and 4%, but combined they're 8%. So they're actually one of the larger categories. And the way that inflation gets calculated is you take this weighting and then you multiply it by the percentage change of this category. So you've got a CPI for shelter. And then we'll look and see, okay, from August 21 to August 22, that grew 6.2%. So what the Bureau of Labor Statistics does is it takes this 32.2%, multiplies it by 6.2%, and that creates a number, which in this case is about 2%. It does the same thing for all these different categories and adds it all up, and you basically get what's a weighted average. And when you look at these categories account for close to 90% of the CPI. So this is what's really important. And if you think about what's happened over the last year, think about what's grown the most. So you've got energy has gone up significantly. That's gone up about 24%. You've got food has gone up 11%. Transportation, education, communication services, that's been pretty steady, about 1.5%. But that's what's been driving it. Now, let's say that you own your own home and you've got a fixed rate mortgage, or you've paid your mortgage off. God bless you if you have, right? So in that case, for about 32% of the CPI, your growth is zero. Okay, so this shelter accounted for about a quarter of overall inflation. So overall headline inflation was 8%. If you multiply 32% times 6.2%, you get about 2 percentage points. So 2% of the 8% was shelter. So if you've got a fixed rate mortgage, or you own your home outright, then your personal rate of inflation went from 8% down to 6% because you had zero growth in shelter. Similarly, for new and used vehicles. So I have over 220,000 miles on my car. Knock on wood, I will keep getting good use of it. So I've had to buy a car. I didn't have this 9% erosion of my purchasing power because I've kept my own car. But if you add this up, so new and used vehicles, 8% plus shelter, that's 40%. So think about it. If you've got zero for those categories, then 40% of the inflation is zero. And as you think about, then you've got energy started to come down, and hopefully over time these other categories will start to come down. So your personal inflation rate can get to be pretty low. Now, as an aside, for me, so I have two teenage daughters. I don't know how they said apparel was only a 2.4% weighting. So for me, it's probably higher than 2.4%. But the growth there hasn't been terrible. It's been 5%. So it's important for folks to keep in mind that your inflation rate is different. And you need to think about, let's say you've got an investment portfolio and you've got a number of bonds that are in it. You need to think about, okay, let's say these bonds are making 8% a year and there's an opportunity for capital appreciation. Well, how could my purchasing power be eroded? And apply what you think your growth rate is in all these things. And in my view, your personal rate of inflation is likely to be less or material less than what it's been reported at. Last point I'm going to make is with regard to the size of your portfolio. So you see here, you've got all these different categories. And let's pick on food for a moment. And let's say, just for the sake of round numbers, that you have a monthly food budget of $1,000. That'll obviously be higher or lower depending on who you are, right? Now, let's say over the last year, your food budget went up 11%. So it went up 11%. It's a little more than $100, right? So it went from $1,000 a month to $1,100 a month. So you've got $100 a month extra per month that's going out the door. Well, if you've got a significantly sized portfolio, the fact that you've now got a higher food budget of, let's say it's $100 or $200 or whatever it is, and the fact that your gasoline's gone up and those things, that's going to be a fairly small part of your overall investment income and your overall investment portfolio and potentially your overall income. So the more money you have, the less this means, but you can still take advantage of what's happened over the last, call it 9+ months, and that you've had bond prices crater. They've cratered because of the Fed and because of inflation. People have gotten scared. People have sold their bonds. But you can take advantage of that because at least the inflation part of this isn't going to impact you the way it's going to impact other investors. So this gave you another way to think about inflation. This is a big part of what Bond Savvy does, is that we come up with a different way to approach bond investing than many others. So I hope you enjoyed the video. Be sure to like the video, to subscribe to the Bond Savvy channel, leave a comment, and thanks so much for watching.